always like to start my talks out by letting you know that I publish a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. You can't hear it? Okay, now we're on. Okay. All right, so I always like to start out my talks by letting everyone know that I publish a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and that I host a radio show called Turning Hard Times into Good Times that airs live on the Voice America Business Channel at 3 o'clock Eastern Time, 12 o'clock Pacific. And then the following day you can catch it via podcast at Jay Taylor Media. Go to the podcast page. All right, I've titled today's show, or today's, I think I'm doing a radio show, I guess. I titled it, here's the people here, so. Which safe haven markets will dominate in 2019? And last year, the theme that I used at the Metals Investor Forum was a year of epic market disruptions. I think towards the end of the year we started to see what I expected we would see in 2018. I think we're seeing a bit of a reprieve now, but I do expect that we will start to see some difficulties in the equity markets as the year goes on. Normally, what you see there is a S&P 500 chart and the 10-year Treasury yields. When people are confident about the system, you see when money comes out of stocks, they go into bonds, the yields fall. And we've seen that happen at the beginning, well, since the end of last year, from November on till about now. That sort of normal relationship has held up. In 2018, the correlation wasn't so clear, it wasn't so normal. There was a lot of money coming out of both stocks and bonds for a good part of the year. And so what I want to find out, where will the safe haven be in 2019? Will it be simply a move to the treasuries, driving treasury yields down, or will there be some leakage out of the financial system into gold as a tattered and torn US dollar becomes ever more dangerous and the creatures swimming around also? There have been quite a few years, in fact, since 1971 when we went off the gold standard, that we've seen money come out of stocks and bonds. And the pink lines there give you the years when that was true. And of course, in the early 70s, after Nixon took us off the gold standard, gold was suppressed at 35 bucks or a little above that. And when gold was free to float, to go where the market would take it, we had these enormous gains. At the same time, money was coming out, lots of money was coming out of equities and stock and bonds. So treasuries and equities and interest rates, of course, went up dramatically. My first mortgage was a 17.5% mortgage in 1981. Now you see that every year there, gold, every year since 1971, gold has done very well, with one exception, that being 1981. When it went down 32%. That's when Paul Volcker slammed the brakes on the economy, causing interest rates to rise to double digits, as I just noted. And he really broke the back of inflation, and gold really took quite a hit. But you could get over 10% on your treasuries in those days. Now, one thing we tend to look at, we all tend to think in terms of what's happening yesterday or right around the present time, and we think of the dollar being relatively strong. Well, this gives you a picture since Ronald Reagan's days. The trend in the dollar has definitely not been up. It's been dramatically lower. This slide is a little bit dated. We've seen this. We've seen the dollar index go up to about 97, but it has never gone above the previous highs going back into the 80s and 90s. Now, there's some real reasons, I think, why the dollar is continually getting weaker, why I think the American economy is not what it's cracked up to be. There's some real fundamental reasons. When you print money and dramatically increase debt, this slide really shows that it becomes counterproductive at some point in time. The yellow line there shows nominal GDP, and the blue area there, the productive debt. It shows the amount of debt that we could have issued and it would have been good for the economy. Beyond that, you get to the unproductive stage and then the counterproductive stage, and I think quite clearly that's where we are now. Now, the Keynesians have always told us that what applies to your family budget doesn't apply to governments. But over the long run, I would argue that that's not true. And so we see here the cumulative effect of debt on GDP. In other words, if you take away the accumulative debt take away liabilities from assets, and you see you have a dramatic decrease. And a very interesting quote from Paul Volcker when he was a young man. He was asked his mother why we can't have boats like those people do, and she said, because we don't have mortgages. So debt is clearly its consumption pulled forward, and the Western world has been living high on the hog, living very, very well beyond its means, because foreigners have been willing to lend us money, and the Americans have not been willing to pay the way for our wars and our socialism and so forth. We've left other countries do that for us, and I think that day is coming to an end. And for good reason, because we are going broke. I believe we are going broke longer term. You know, when the system breaks down is the question. That's one of the reasons I'm asking the question I'm asking this year about where will the safe haven be. So this slide shows it shows the amount of debt that goes into the various items that the government spends. And you can see the orange line, what starts to happen with interest expense. Because the debt has grown so much more dramatically than tax revenues or GDP. And you can see the various, going forward now, we get to something like in 2030, we get to the point where the interest will eat up everything, all the tax revenues. There will be no money for anything else that the government does. And that's the Office of Management and Budget, which is generally not coming out with any crazy ideas. And I think in this assumption, I don't know exactly all their assumptions, but one of them I believe is that there will be no recessions. Well, that's, you know, how likely is that? I think Eric made a very good case this morning, reasons to be fearful and concerned that we may be entering one this year. This slide really tells the story. I mean, back in 1970, a 1% interest rate added $3.7 billion to the U.S. spending. Now with our total debt at $20 trillion, a little more, projected to be a little more, 21 trillion. So we're looking at something like a 1% increase of $212 billion a year for interest expense alone. I run this, I chart this at home all the time. During the Asian crisis of 1998, there was an analyst from Merrill Lynch who charted this, he called it the 52-week global US dollar liquidity. 1998, obviously the wheels came off, there was a global liquidity crisis. And so I started watching this ever since, and you can see the dramatic rise, of course, after 2008 and 2009 when the Fed started QE and pumping trillions of dollars into the system, dollars that are not asset items, they're liability items, because unlike a gold-backed currency, we have a liability currency. Every dollar has a liability behind it. Now this is the composition of global US dollar liquidity is the monetary base, the US monetary base plus US treasuries held by foreign central banks. You see the dramatic drop-off in 2008. All of a sudden foreigners, well really what happened, the US increased its side of that equation, and so we had this dramatic decline in the portion of foreign holdings of US dollar liquidity. And that has gone down from over 70% to around 45%. It's crawled its way back to 50% as the United States and the Fed has been the tightest central bank. So I think that Chairman Powell has really been hoping and trying to restore confidence in the dollar, restore confidence in the system by hiking interest rates. The problem is we can't. I think it's very, very difficult to increase interest rates now for the reasons I just discussed. And so actually Danielle DiMartino Booth, who was an assistant to Richard Fisher at the Dallas Fed, she's been on my radio show as well, and she's frequently on CNBC and other television shows. She was really very, very bullish on Jay Powell, and she tweeted this out the other day, "I'm flummoxed by this man I once had such faith in." Well, I don't know why Danielle had such faith in him to start with, because he has an impossible job. Any Fed chairman, there's no way they can get out of this mess that we're in. So what are the possible causes of monetary regime change? I'm talking monetary regime change. I'm old enough, most of you in here probably weren't adults when Nixon took us off the gold standard. I was like 20 years old, and I remember it very well, and I thought this is going to be a disaster. Well, it's held together for a long time, and in fact, a lot of people have gotten very rich because of the redistribution of income that has occurred by going off the gold standard and printing money. The people closest to the printing presses, the bankers, the governments, they've gotten very wealthy. The miners, the manufacturers, the inventors, farmers especially haven't done well. The middle class has suffered dramatically, I think directly because of the regime change, the monetary regime change of 1971. Nixon, he's had us on this paper money system for all of these years, and because of that, we have this dramatic debt and the insolvency of the global economy, in my view. So there's a number of things that could go wrong, but I think that the debt trap, the Federal Reserve, its inability to, well, we don't have anybody to pay for the debt, and the debt is surging. Where is the money going to come from? Is the Fed going to have to simply print its way out? I think Jay Powell signaled that last week, and the markets turned around and headed up. I think the markets are looking at more liquidity. They've basically called his bluff, and I think that we're going to see more and more money printed. But again, that only exacerbates the problem, more debt relative to GDP. So the system keeps, every time we have one of these major problems, one of these major liquidity events, 2000 and 2008, before that 1997, whenever we have, year 2000, so whenever we have these events, they just paper it over. But they haven't solved anything. They've just bought some time, and more people get rich at the expense of the common folks that produce real wealth. And there's some real reasons for that also, because when you distort the price of capital, you do not, the Federal Reserve and other central banks are not allowing capital to be priced. There's no price recognition of capital. It's a distorted price of capital at much lower levels, and so as a result you have capital flowing into industries that cannot survive under normal circumstances. So you're misallocating capital, which means that your GDP is not going to keep up with your debt growth. And that's a sickness of the whole Western world. Everybody bought into the Keynesian idea, so somewhere along the line this thing is going to break down, I'm sorry to say, but I believe it will. And the Chinese and the Russians, after 2008, and other countries started to look at alternatives to the dollar, and they started building up their gold supplies very dramatically. This shows Chinese gold production, the yellow bars, and the red is the imports of gold. This is a couple of years out of date, but it's continued on, and so has Russia increased its gold reserves very dramatically. And they are starting to get rid of dollars and starting to trade amongst themselves using their own currencies, and I suspect that gold backing is there to help reassure the nations that they can trust each other's currencies and get out and away from the dollar, which they see as a curse for them. This is the China and India gold growth combined, very dramatic growth. Meantime, the developed markets are not, they're not keeping up. They're basically dishoarding and have been dishoarding gold for years and years, while the developing markets, this slide shows, increasing gold holdings very dramatically. So again, the major years, there have been some years since then, but these are the major years when gold really was the beneficiary, with the exception of 1982. That was the year that Volcker slammed the brakes on the gold, on the money system. And I think that we could be looking at something very similar to that, at least something where confidence is shattered in the dollar and the current monetary regime. Now, all of this is speculation, and I think that it's very difficult to know where things are really going to go. We try to figure it out as best we can and understand, but it's too complicated. So I really like the work of a technician that I use, and he's on my radio show every week, almost every week, Michael Oliver. And this is his gold. He's a momentum, structure and momentum guy. He doesn't pay much attention to price, he pays attention to structure. And usually he gets you into a market earlier at a lower price than the price watchers do. I listened to Eric's show this morning, and he made the statement that he wants to see gold around 1360 to get really confident. That's Michael's number as well, by the way, but that's a price number. Michael's not waiting for 1360. He's had 3 different times when he's gotten you in since the bottom of 1161. I've watched his work over and over again. I'm fully confident in what he does, and so I trust him I'm sure he's not infallible, but he's been very good as any technician. From my perspective, not as a trader, but as one that wants to know, should I really exit gold stocks or should I be back in them for the long run? Michael's been very helpful, and he's helpful in all the markets in that regard. But I've seen his momentum and structure work get people in at a more opportune and out at a more opportune price. So with the dollar, he's also very bearish, and he sees a breakdown in what he terms the recent counter-trend rally for the dollar, that is over now in his view. This is a chart that he put out last week. He's convinced that we're going to see some real weakness in the dollar this year. So much of what Michael's saying, I had to think when I listened to Eric this morning, they're really very much in compliance from different vantage points, of course. Again, this is the dollar picture I showed you earlier, and the current cycle, it shows, I just drew that red line because I wanted to just show you that the heights in this cycle, in this counter-trend rally, has not exceeded the heights of going back, except, going back into the past, except for the most recent high back in 2004 or thereabouts, I guess. And with respect to the equity market, the S&P, as far as Michael's concerned, it's over. We're going down. And he just chuckles at this notion that we're going to have any meaningful upside rally here. I mean, this is a veteran guy. He's my age, more or less. He's been around forever. He trained with some of the top technicians on Wall Street, worked for major firms on Wall Street, now is doing his own thing. I just found him to be, I talk about him because I find he's so useful for my purposes. Just a gold chart that shows you, in spite of all of the good times that we've had, gold continues to rise. Well, we've had a pretty rough time since 2010 in this sector, but I think it's probably about over. The point is that this isn't that gold is going up. The dollar is being destroyed. And I think there's a lot of interest that want to see gold subdued. Massive paper games that are played in the futures markets. It's in one single day as much paper trades as gold produced in an entire year. The banks continue to hammer those markets. Now watch palladium. It's another story. I don't have time to talk about it, but palladium is a metal you have to produce cars. And palladium prices are reaching new highs almost every day. Keep an eye on palladium. North American Palladium is one that I have in my newsletter that I think has been doing very, very well. So that's the big question. We know which way are we going? Where will the safe havens be in 2019? Will they be? We started to see the safe havens in 2018 going into gold, a little bit coming out of treasuries, going to treasuries and gold. So far, since about November of last year, we've seen a more normal confidence, risk-on trade, where stocks are going up, and so it's sort of the normal thing where people have confidence, and so when money comes out of the stocks, they go into bonds, and vice versa. But when the whole system starts to come under, starts to be challenged, and the confidence is challenged, it can become a different story in a big hurry. Again, this is a chart that shows all of the years. Last year was one of those years in which money came out of both the treasuries and the equity market. But what are the chances of Paul Volcker, of the current Fed chairman, tightening like Paul Volcker did in 1980, 1981, when interest rate, treasury rates were 12, 14%? I mean, think about it. A 1% rise now adds $212 billion to the U.S. expenditures. So this is, it's not doable. I think you have to watch. There's going to be some fireworks ahead, I'm afraid. And I'm a gold bug, not because I want this stuff to happen, but because I've seen it happening. It's going to happen. Looking back since 1971, I've been convinced there's no way out of this mess. I wouldn't have believed we could keep it going this long, but it has been quite a party for the people on Wall Street and the financiers and the governments, by the way, that have financed it. All right, so this takes me to the companies that I've invited here. Avrupa Minerals is a prospect generator that is probably, it hasn't had much news recently, and I know we're going to hear in just a moment why that was true, but there's some very good things happening. Now the company's coming to life in Portugal. I really like this story a lot. New Range Gold Corp, that is one that, I mean, I really got excited about this story a couple of years ago. They have the Pamlico gold project in the northern end of the Walker Lane Trend in Nevada. It pulled together a whole bunch of different mom and pop operations over the years with some really high grades there. Robert Carrington is the chairman of the company, and he obviously was overworked and needed some help, and I was really, really glad to see Bob Archer come on. I've known Bob from his days at Great Panther. I think this really is a game changer for this company, very positive. Now, Uranium Energy Corp has been sleeping for a while, but I think we've got some things happening here, a little bit like palladium in some ways. The supply-demand is moving in the favor of producers, finally, after many, many years. And this is one of the few companies that is available, can start producing uranium as soon as they get the price they need to make it profitable. And Amir Adnani will tell us about that in just a few minutes. Just another chart from Michael Oliver. He has turned very bullish on uranium. The bottom chart there is his momentum chart, and it shows you it's considerably above the momentum point that he needs for a breakout. Triumph Gold is we'll also be telling a story in a second here. The Free Gold Mountain project in southern Yukon was one that I followed a number of years ago. That company fell on hard times. New people, new company, Triumph Gold took over, and John Anderson will tell us about that story. But I mean, one of the eye-popping assays this year was 316 meters of 1.79 gold equivalent measurements, 1.79 grams per ton. And that was in a porphyry discovery that's a very exciting story. They already have something over 4 million ounces, I believe, total of gold equivalent ounces, but this is, I think, a really marvelous story. So I'm going to leave the company's talk now, and that's where you make the money. So, all right, so Avrupa first. Yeah.